Hello everybody, welcome to today's fundamentals. Hello Peter.
Hello.
What's up in the FX market?
Well, we had a US dollar which was a bit slightly up, but overall there was a sideways motion against counterparts, no major movements or reactions. Overall we had rather low volatility in the FX market. I would be noting as maybe the main fundamental issue the negotiations for the US debt ceiling and the possibility of the US actually defaulting on its debt. There was another round of negotiations between US President Biden and House Speaker McCarthy, which is a Republican. Practically, on the one hand, okay, there was some optimism, but no deal was reached. So practically market worries are being prolonged. And should they intensify, we may see that weighing on riskier assets. Other than that, I would be noting that, okay, we had a number of Fed speakers. Across the world, it was an interesting release from Japan during today's Asian session. We had Japan's preliminary PMI figures. They were for May. And the manufacturing sector, for the first time in months, has shown an increase of economic activity. The reading of the PMI figure was above 50, even slightly, and that was a positive given that there is an industrial direction in the Japanese economy.
Mm-hmm. And how has gold's price been reacting?
Yesterday there were some slight bearish tendencies. I think those bearish tendencies more or less intensified during today's Asian and European session. We expect more or less the negative correlation of the US dollar with gold to play a key role regarding the precious metals direction. Should we see the US dollar gaining further during the day, we may see gold's price plummeting even lower.
Mm-hmm. And how about US stock market?
US stock markets were a bit mixed. We saw, say, for example, S&P 500 dropping, but on the flip side, Dow Jones and Nasdaq were in the greens. I would be highlighting as the main issue here, definitely the US debt ceiling discussions, but also Fed policymakers and whether the Fed policymakers will be maintaining a hawkish stance, which could weigh on US stock markets. There are still some earnings reports which are due out, but overall the main body of high-profile companies have already released earnings reports, so we may see also a shift of the market attention slowly but steadily shifting away from US stock markets, and we may see some influx in the FX market.
Mm-hmm. And how about oil prices?
Oil prices were also in a sideways motion. It's as if they maintain a wait-and-see position. There are demand issues on the one side, which we would be noting, say, for example, that we have the Chinese and whether the US is going to be slowing down, thus may have an adverse effect also on US oil demand. On the flip side, on the production side, or if you prefer the supply side, there are worries about a slack in the US oil market. And we may see some attention from oil traders on today's AP weekly crude oil inventories figure. Should there be another surplus, another buildup of US oil inventories, that would imply that demand was not able to reach production levels and practically, once again, would be highlighting the slack in the US oil market.
Mm-hmm. And what's in today's calendar?
Well, let's start with the European session. We had already Eurozones, actually Germans, France's, and the Eurozones as a whole preliminary PMI figures for May. And they were not as good as expected. We highlight here the problem child, which would be Germany's manufacturing sector. And for May, we saw an even deeper contraction of economic activity for the month. Definitely the tightening of ECB's monetary policy had an adverse effect on the manufacturing sector as a whole. We saw a similar reading also for France. And I would note that should the issue be maintained, given that okay, there has been a contraction of economic activity to various degrees in the past 10 months, though. But that was on a continuous basis. So practically, it's quite worrying, the fact that economic activity in the spearhead of Eurozone's economy, and that would be the German manufacturing sector, is dropping and dropping and dropping constantly. On the other hand, I would be also noting that we're getting from the UK this preliminary PMI's figure for May. Main market attention is expected to be on the services sector, given that the services sector has most of the country's GDP. Should there be a slowdown or even a contraction of economic activity, albeit most probably that would be a slowdown, we may see the pound weakening slightly. On the monetary front, I would be noting that we have a number of ECB policymakers which are scheduled to speak and could sway the market's opinion, especially should they sound hawkish once again. May we remind our viewers that practically we had ECB President Lagarde, which was giving some quite hawkish signals on Friday. We expect that rhetoric to be maintained also today, and that could provide some slight support for the euro.
And how about the American session?
Well, in the American session, I would be making a start actually with Canada. We get the PPI prices. And the rate, should it accelerate on a month-to-month basis, it was for March at 0.1. Should April's reading be a little bit higher, that could imply further inflationary pressures within the Canadian economy and could provide some support for the CAD. I would also be noting in the American session from the US, the preliminary PMI figures, the S&P ones, and therefore May. Main focus would be on the manufacturing sector. Should the indicators reading drop, that could weaken the US dollar somewhat, but I would also be noting the new home sales figure. It's for April. It's expected to drop. We tend to maintain our worries about the real estate sector and the construction sector in the US substantially. The Fed's monetary policy tightening has slowed down economic activity substantially. And in my opinion, that would be a clear signal that maybe a mild recession may be nearing the US economy here. It's going to be interesting to see also how the new home sales have evolved over the past month. Should they have dropped, that could weaken the USD. On the monetary front, I would be noting Dallas Fed President Logan, but I would also be noting that we have another Eurozone speaker later, near the end of the American session. That would be ECB policymaker and Germany's Bundesbank President Nagel. Now, Mr. Nagel usually tends to lean on the hawkish side, even maybe a little bit more hawkish than ECB President Lagarde. And so should he actually renew the tendencies for another rate hike and leaving the possibilities open for September, that could provide some support for the euro.
And what about tomorrow's Asian session?
Well, in the Asian session tomorrow, New Zealand comes in the forefront. We have the retail sales growth rate for Q1 of New Zealand. However, that is expected to be overshadowed by RBNZ's interest rate decision. Now, the bank is expected to hike rates by 25 basis points. That's the base scenario. At this point, though, we would highlight the risk of the bank actually proceeding with a 50 basis points rate hike. And should that be the case, we may see the Kiwi getting some substantial support. I would also be expecting some considerable attention to be placed on the bank's accompanying statement. Now, should the accompanying statement maintain a rather hawkish content, foreshadowing more rate hikes or at least more tightening to come, that could also provide some support for the Kiwi. Anything less, we may see NZD dropping.
Great. Thank you, Peter, for your time and everyone for watching. Join us after a short break for technical analysis with Peter Iosif.
So welcome to the technical analysis part of the presentation for today. In front of your screens, you have the US dollar. Actually, it's the Dow Jones. Let's switch to the US dollar index. There you go. It's an interesting movement in the sense that we see more or less the upward motion of the index being maintained. And that would be something like this. There is a catch here, and we have to know it. But first of all, before we discuss direction, let's correct the support and resistance lines. Definitely this one has to be turned into a support line given that the price action has moved above it. Let's go hunting for an ultimate upward in red, the 107.10 resistance line. You can see how there were 1, 2, 3, 4 touches. Seems to be quite valid. Now there is an inconsistency with the support lines, so let's fix that as well. And I would be noting the 100.45 green. Let's correct the labels. Hundred and 1.45, sorry, 55. 102.45. 103.05. 104.5. 105.45. 107.10. Let's lock everything in. Now there are two elements which tend to suggest that there is a bullish outlook here. The first is that the RSI indicator has moved a little bit upwards. It's now at 64.4, more or less implying a rather bullish sentiment on behalf of the market for the US dollar. Also, the upward trend line seems to be maintained despite the interruption here. On the flip side, though, I wouldn't adopt a bullish outlook unless we saw the US dollar index actually marking a higher peak than this one. So we needed to rise higher and actually aim for the 104.05. Also note how the 20 moving average, the 50 moving average, and the 100 moving average all are pointing upwards. So should the bulls maintain control, I would expect the price action to reach as high as they are 104.5, maybe even reach it. On the other hand, should the pair prove unable to mark a higher peak than this one, let me encircle this in red. then practically we may see it maintaining a sideways motion with the S100 and 305 providing support or even becoming the axis around which the price action will be revolving. While for a bearish outlook, I would require the pair to drop, break the upward trend line. Once again, break the 100 and 305, definitely, and also break the 100 and 245. We have to see that there are some sincere bearish intentions on behalf of the market, and I would require nothing less than the breaking of the upward trend line. There's one and there's two. For the time being, once again, we note the bullish tendencies, yet would require the pair to reach the R104.05 for a full adoption of a bullish outlook for the pair. Okay, let's move now to Euro USD. The situation here seems to be quite different. There are some slight bearish tendencies in place, but nothing conclusive just yet. The RSI indicator has dropped. It's at 39.2. May imply also some bearish tendencies. Note how the moving averages 20, 50, 100 are all pointing downwards. All that tends to support the idea of the price action following a bearish movement. On the other hand, though, I would require the pair to drop below this trough here and actually test the S1 1.0715 and actually break it. So for the time being, I tend to maintain a bias for a sideways motion to continue. I need to see more conclusive evidence before actually adopting a bearish outlook. Should the bulls take over, we may see the price action rising, breaking the R1 1.0845 and start aiming for the 1.0965. Let's have a look at GBP USD. A very, very similar picture with Euro USD, with the exception that the bearish tendencies seem to be a little bit more intense, at least for the current price action in the European session. And should the bears actually take control, I would expect them to break the S1 1.2350 and start aiming for the 1.2185. On the flip side, should the bulls take over, we may see the price action of GBP USD rising, breaking the R1 1.2540 and start aiming slowly but steadily for the 1.2770. For the time being, though, once again, we tend to maintain a bias for a sideways motion, yet we highlight the bearish tendencies, and should the pair break the S1, then I would be definitely switching my outlook from a sideways motion bias in favor of a bearish outlook. Let's have a look at USD/JPY. Once again, similar picture, yet to the upside this time. The sideways motion tendencies seem to be more intense, albeit we note that the moving averages are supporting the idea of an upward movement. Note the RSI indicator, it has corrected from its previous highs, but still at considerably high levels. It's at 60.4.5. So that tends to imply on the one hand that the bullish sentiment has subsided a little bit, but it's still present. Nevertheless, for the time being, we tend to maintain a bias for the sideways motion between the S137.75, which provided support right about here, but also resistance out here. So it seems to be pretty valid. To the upside, we note the R139.40, and we would expect a sideways motion between the pre-mentioned levels. Should the bulls actually take charge of the pair's direction, we may see USD/JPY rising, breaking the R1 139.40. Definitely a break of the R1 would be required for a bullish outlook. And at that case, we may see it start aiming for the R242.20. On the flip side, should the bears take over, we may see the price action of USDJPY dropping, breaking the S1 137.75 and start aiming for the 135.40. Let's have a look at USDCHF, the other safe haven currency pair. Now we get a different picture here, but actually I would be saying that this picture resembles more the US dollar index than any other pair we have seen before. Let's rise further. And here we go. Let's lock everything in. So are there any bullish tendencies or not? Once again, I would require the price action to have a higher peak than this one. So the pair for bullish outlook has to A, break the R1 0.9020 and start aiming for 0.9115. Actively aiming. The price action has to surpass this peak here. Should the pair form a peak lower than this one, then we may be talking about a reversal of the upward movement, or at least a stabilization of the price action of USDCHF. And in that case, we may see it maintaining a sideways motion just below the R1 0.9020, or even slightly above it, with the R1 being an axis of the sideways motion. For a bearish outlook, I would require the price action to drop, break the upward trend line, break the S1 0.8935, and start actively aiming for 0.8860. For the time being, note how the RSI indicator has risen, broken just above the reading of 50, implying that the bullish sentiment seems to be building up. On the flip side, though, the market seems to remain rather undecisive for the time being. So I would maintain a bias for the sideways motion, yet I would also be noting the bullish tendencies of the pair. AUD/USD, clear-cut sideways movement. No question on that one. Okay, the RSI indicator has retreated after hitting on the reading of 50. Actually, it reached 51 and now is at 40. Actually, it's at 38.9. 39. Okay. I'm still not convinced about the bearish tendencies of the pair. For a bearish outlook, I would require the pair to drop, break the S1 0.6580 and start to actively aim for the 0.6450. On the other hand, should the bulls take over, we may see the price action rising, breaking the R1 0.6690 and start aiming for the 0.68 resistance line, the R2. Note how the level has provided resistance here, here, and here. Quite interesting. On the other hand, note how the level of the current level of the price action is at the support line practically. Note that it provided support here, here, and here, and was the low boundary of the past sideways motion. It's going to be interesting to see whether that holds, and if that's the case, then we would definitely have to correct the S1 higher somewhere here, like this. But that remains to be seen. Okay, let's move to USD CAD. A similar picture as AUD USD, only in the reverse. Let me readjust the labels before we start talking direction here. For the time being, we tend to maintain our bias for a sideways motion to continue, and for a bullish outlook, despite the despite the rise of the pair during today's European session, I would require to break clearly above the R1 1.3545 and start aiming for the 1.3665. There is a bullish sentiment building up. It's characteristic that the RSI indicator is currently at 61.7.8. So that definitely tends to imply that the bulls are building up the market sentiment. On the other hand, note how the price action during today's European session was stopped from ascending higher after hitting on the upper Bollinger Band, which may slow down the bulls or even stabilize it. Note though that on the other hand, there is an upward shift of the Bollinger Bands, including its median, the 20 moving average. And note how the 50 moving average in green is about to break above the 100 moving average in orange in a sign of a bullish signal should it actually break above it. Okay. Let's move now to NZD-USD, the Kiwi, given that we have also RBNZ's interest rate decision. Now, the Kiwi has maintained a sideways motion despite edging lower during today's European session. That should be no surprise due to the strengthening of the US dollar. Definitely that would lead us to switch the S1 0.6270 from a support line to a resistance line. Let's reposition the labels lower. Starting with the R3, which is now being placed at 0.6430. The R2 at 0.6350. The R1 at 0.6270. The S1 at 0.6190. The S2 at 0.6090. And the S3, we reaffirm that, at 0.5980. So for the time being, we tend to maintain a bias for a sideways motion. Note how the RSI indicator has dropped from the reading of, let's have a look, 62 all the way down below the reading of 50. It's actually right now at 46.7, implying that the bullish sentiment seems to have been eroded. So that's out of the picture, but it's still too near to the reading of 50 to call in the bears. So I would expect the market to remain rather a little bit undecisive. Yet should the bears maintain control or even intensify their efforts, I wouldn't be surprised to see the price action dropping, breaking the S1 0.6190. It's the next stop for the bears given that it has provided support here. I would also note this one, and this one, and this one. Pretty valid. On the flip side, should the price action remain in sideways motion, I wouldn't be surprised to see it revolving around the R1 0.6270. Note how that has been done over the past 24 hours, actually even further 48 hours. In the unlikely scenario, but still a possibility, which should not be neglected, of a bullish outlook, we would expect the price action of NZD-USD rising, breaking the R1 0.6270 and start aiming for the 0.6350, if not even reach it. Note that NZD-USD is expected to be moved or have increased volatility due to the release of RBNZ's interest rate decision. That's due tomorrow during the Asian session, but I would expect the market to start positioning itself ahead of the release. So we may see the market sentiment affecting NZD-USD's direction. Let's have a look at XAU-USD gold. Bearish sentiment seems to be building up. Definitely the break of the 1972 forces us to switch it into resistance line. Let's go hunting for a new ultimate support line. One level would be here. And it's an interesting level in the sense that it has provided support here, resistance here, here, and here, as well as here and here. Seems to be valid. I'm keeping it. That would be in green, please. The 1885. Yep. Let's readjust the chart. Starting with the R3, which is now being placed at 2050. Sorry, 2020. The R2 at 2000. The R1 at 1972. The S1 at 1945. The S2 at 1913. And the S3 at 1885. We just saw that. Locking everything in. So let's talk direction. On the one hand, we see that the price action of gold has been dropping. That's being reflected also in the RSI indicator, which is now at 38.9. So there seems to be a bearish sentiment building up, which could lead gold's price lower. Yet for the adoption of a bearish outlook, I would require the precious metals price action to drop below the S1 1945, start aiming for the S2 1913. Definitely a break of the S1 would be required here, nothing less. Otherwise, should it fail to break the S1, then I would expect it initially to maintain a sideways motion between the S1 1945 and the R1 1972. For a bullish outlook, no matter how improbable that may seem, once again, it's still a possibility and should be covered. I would require the price action of gold to rise above the R1 1972. So it would have to break the former support line, now turn to resistance, and start aiming for the R2 2000. And when I'm talking about aiming the R2, I mean about an active aiming, which would be definitely higher than this peak here. So it has to reach almost all the way up to 2000 once again. Let's have a look at oil. Clear-cut sideways motion. No major volatility here. Note how also the moving averages have flattened out. The RSI indicator is running just above the reading of 50. It's currently at 51.9. So that tends to imply also rather indecisive market. Note how the Bollinger Bands have narrowed, implying low volatility for the commodities price, which could allow also the sideways motion to be maintained. Should the bulls take over, I wouldn't be surprised to see the price action of WTI rising. Breaking the R173.90 actually would require that, given that the R1 has provided resistance once, twice, 3 times, 4 times. So that's a pretty valid level to the upside for the time being. Next possible target for the bulls could be the R276.80, given its action here. On the flip side, should the bears take over, we may see the price action of WTI dropping, breaking the S169.20. And I would require that, given that we have a true here, which is supported at that level. Note how the level also provides support here, at least some hesitation here. Lower than that, next possible target for the bears could be the S2. It's a little bit wide. We're talking about almost $5. It's $4.90 per barrel. And actually, the low volatility of the past few days does not allow for such movements, but it's still a possibility. Note how such a distance was covered in the past. By the way, let's have a look at the validity of this 264.30. You can see that practically there is no price action with the exception of this true here that tends to support anything else. On the contrary, this true, which was a beautiful drop, then reversed to the upside, was very characteristic. And you can see that the S2 also provided support here. And another characteristic, wide drop lower, reversing it to the upside. Back, readjusting the chart. Once again, to recap it all, we tend to maintain a bias for the sideways motion to continue between the R1 and the S1, albeit we may see WTI's price remaining in a narrow corridor than this. For a bullish outlook, we would require the price action of WTI to rise above the R173.90 and start aiming actively for the R276.80. While for a bearish outlook, we would require a clear break of the S169.20 and the price action of WTI to move decisively lower. It may not reach the S2, but definitely start aiming for it. Let's have a look at US stock market, starting with Dow Jones, which sent some mixed signals yesterday. And it's understandable given that we had a sideways motion. Let's readjust the chart a little bit, position the labels so we get a clearer picture more easily. It's important that the trader gets the picture at the first glance. Say, for example, show how a sideways motion, the boundaries of a sideways motion are. Well, should it be in an upward or a downward motion? There has to be a clear-cut downward or upward trend line supporting the price action or limiting it. For the time being, we definitely note the sideways motion between the R1 33,660. Note how the level provided resistance here and here, support here, here, and here, and resistance here. So it's a pretty valid level which was tested a number of times. To the downside, we note the S1 32,980, which has provided support here and here. So the sideways motion could go lower, yet bounce on the S1, aim for the R1, bounce on it, and drop again. It's pretty wide. I understand that. We're talking about around 700 ticks. So it's an issue. but it's still there. You can see the peaks and troughs marking the corridor in which the price action is moving. Should the bulls take over, which may be somewhat difficult, but still it's a possibility, we may see Dow Jones rising, breaking the 33,660 finally, and we're talking about a clear-cut break, which would allow the index to start aiming, if not even, I wouldn't say reach, but pointing towards the R2 34,275, a level which was providing resistance back here. That would be around the beginning of May. To the downside, should the best take over, I would require for bearish outlook the price action of Dow Jones to drop below the S1 32,980, a level which provides support here and here. We have noted that. And start aiming for the 32,330, a level which provides support here. Pretty valid. Let's move now to S&P 500. Okay. We have to make some corrections here. Now this has to be turned into a support line given that it provides support right now. It's being tested right now. It could be broken at any given moment. But overall, there seems to be a sideways motion on behalf of the index. And the last one. Here we go. Now we have to go hunting for a new ultimate resistance line, given that this one has been broken. The R1 has been broken and now turned to support line. Let's unlock the chart, move backwards to find a peak which would be suiting us. Okay, it's a little bit off, but still a possibility. Too wide. I would be marking this one. We had touches here, 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 here. Pretty valid in here. Okay. And red, and that would be the 4,400. We're adjusting the chart. Let's correct the levels as well. Starting with the S3, which is now being placed at 4,100. The S2 at 4,155. The S1 at 4,190, pretty close. The R1 at 4,260. Let me reaffirm this. Yep, correct. Sorry. The R2 at 4,325. And the R3 at 4,400. Locking it in. For the time being, we tend to maintain a bias for the sideways motion to be maintained, given that the price action seems to be moving in a sideways motion over the past 48 hours. On the other hand, though, there seem to be some bullish tendencies, given that we have the 20 moving average, the 50, the 100, and the 200 moving averages. By the way, let's correct this and change it into a 50 moving average. and a 100 moving average. That gives us a clearer picture here. So despite the upward signals provided by the moving averages and escaping the flattening over the past weeks, I would be noting also the drop of the RSI indicator. It was at very high level, not very, but at quite high levels. It was at 68, and has corrected lower all the way down to 55 and still dropping. So that tends to imply that the bulls are losing on the market sentiment. And I would expect the price action to remain in a rather indecisive mood about S&P 500's next direction. So for the time being, we tend to maintain a bias for sideways motion to continue, probably just above or around the S4190. For a bearish outlook, I would require the price action of the index to drop below the S1, clearly break also the S2, and start aiming for the S3 4100. On the flip side, should the bulls take over, we may see the price action rising, aiming, if not even breaching, the R1 4260. Okay, that should sum it up from all of us here at IronFX. Best wishes for solid trading.
Hello and welcome to another of our great videos. Today we'll be looking at slippage. Slippage refers to the difference between the expected price of a trade and the price at which it is executed. So in other words, the difference between the expected price and the executed price is the slippage. Market prices can change quickly, so slippage can occur during the delay between a trade order being processed and when it is completed. Slippage can occur at any time, but is most likely to occur during periods of higher volatility, such as during breaking news of economic data releases. In both situations, forex brokers will execute the trade at the next best price. Under normal market conditions, in forex trading, the major currency pairs would be less likely to experience slippage because they are more liquid. So, let's look at an example. For instance, you are trying to buy Euro USD with a price of 1.1050 and on your trading platform you see the price of 1.1050. You click buy as 1.1050 is the price that you want to execute your buy order at. You send your order to your broker over your internet connection. Once your broker receives the order, he needs to check that you have sufficient funds to cover the new order. From the communication transfer to data processing, the steps all create a delay. This means that from the time the broker sent the original quote to the time the order can be executed, the live price may have changed. The difference in the requested price and the executed price is known as slippage. Therefore, the final execution price versus intended execution price will have one of three outcomes: no slippage, positive slippage, or negative slippage. Thank you for watching.
Okay, I think we're ready to kick off. All right, okay. So today's webinar series by IronFX is about fundamental trading strategy. So once again, the information in this webinar is purely for informational and educational purposes. Please do not construe it as investment advice or investment recommendation. And please do all due diligence prior to uh, putting on any trades across any asset class, right? Okay. So the full risk warning and disclaimer is here on this page. Okay, so this webinar is brought you together in partnership with EFG Everest Fortune Group. We're the finalists for Best FX Research from 2019 through 2021, Best Equity Research in 2020 and 2021. So I'm your host today, Ketan, and let's start things off. Okay, so over here, we have a slide on the data links for where we can get fundamental information about the United States. All right, feel free to take a screenshot of this, but also not to worry. All these other links here can be found on Forex Factory. So basically, you guys just need to know and remember Forex Factory. And once you're on that site and you search for the economic calendar, and I will also teach you how to search for the respective economic news events, and from there we are able to find all the sublinks. Okay, right, so do not worry, you can take a screenshot, feel free, but the main link to look out for is Forex Factory, right? Okay, so let's go and go into Google. All right, okay, so here we have Forex Factory, right? Okay, just a quick note, you guys able to see the page, Forex Factory? Yes. Just maybe a quick show of hands to see that you're able to view that page. Right? Okay, wait, hang on. Yeah. All right, guys. Sorry. Okay, I assume everyone can see my Forex Factory page, right? Okay. So if that's the case, let's continue. Okay, right. Okay, so here we have Forex Factory. Depending on your time zone, it will give you the time. Okay, today is now. Okay, I've not refreshed the page, so let me refresh the page. Hang on. Okay. Yeah. Okay. So this is 6:05 p.m. UTC +8. So this is Singapore time. Today's date is 12th of April. Right? Okay. So now let's just start. Okay, we're going to look at US fundamental data. Okay, so Forex Factory is a good website, and with its economic calendar, which is on the home page, right? So if you come to Forex Factory, I just do a Google search, Forex Factory, right? It will take you to, oops, sorry, hang on. Wait. Yeah, okay. Yeah. So if you do that, yeah, you search for Forex Factory, it'll come here, right? And on the home page, okay, let's just refresh the home page. Okay, if you click on home, it'll bring you to the main page here, and this is the economic calendar right here. Okay, so what we're going to do is we're going to look through, for example, let's just start quickly through the month of March. Okay, so we had the FOMC meeting, right? The Federal Reserve had its interest rate meeting in the second last week of March, right? So 22nd and 23rd of March was the meeting. So let's start the calendar from 20th of March till the present date. Okay. And let's just filter to look only for US related events. Okay. So we'll cover the the events that will have the most impact, right? And we'll cover all the event types and just US. Right. Okay, so this brings us to our starting date, March 20th. and we have a list of various economic events for the US. Okay, so because we are looking at foreign exchange FX, we'll be looking at what central banks are doing. So the FOMC is a big uh, event led by the Federal Reserve, which is the largest and most influential reserve central bank in the world, right? Okay, so let's quickly look at that. So we have this event here, March 23rd, 6 or 7 this is obviously UTC time. So this, because we're UTC plus 8, this will show us as Thursday, March 23. Okay. Now, if we look at the we have the federal funds rate. All right. So if you click on this folder here, it tells us the source of the data and the links and a description. Okay, so I think you guys should be pretty familiar with this. And also, if we click on the graph here, it will tell us the history of the interest rates as well. So how the Fed raised interest rates in 2016 all the way till early 2019 before cutting them and bringing them down to zero because of oh, sorry, not zero, but very close to zero because due to COVID. And then after that, in order to combat inflation, they started uh, raising interest rates very aggressively. This is this period has been one of the fastest, or if not the fastest, rate of interest rate hikes, which has caught many people off. Even though the Fed did uh, forewarn markets that they would uh, aggressively raise interest rates to combat inflation. Okay, so now we have this here. Okay, so if we click on the folder, we click on latest release, it takes us to the Federal Open Market Committee website, right? Uh, so that's what FOMC stands for, Federal Open Market Committee. Over here, we are able to find out the calendar meetings for 2023. And as you can see, the next meeting or the third meeting for this year will run from 2nd to 3rd May. So from now till then, we've got about let's see, what, 3 weeks? Yes, 3 weeks, about 3 weeks before the next meeting comes up, and all eyes will be on Chairman Jerome Powell. And also we are able to view uh the statements, the history, the historical statements and press conference. So if I click on PDF, you are able to read the full press conference, press statement in detail, as well as view the press conference as well. So there's a YouTube video here, which you can, if you choose to, you can read through it as well to determine exactly what uh, uh, the chair Jerome Powell was saying, because his impact, his words during the FOMC meeting can have a meaningful impact on markets moving forward. Right? If he's sounding very hawkish or dovish during the meeting, it can have a meaningful impact on currencies. Right. So when we say hawkish, it means him and his other committee members are looking to further increase interest rates. And if it's dovish, it means he could be pausing interest rates or cutting them. Okay. So we have the FOMC website here. So one of the things to look at is what central banks are doing and when are the meeting and when are the upcoming meetings. So the Fed is the biggest central bank, and it's important to see how they are raising interest rates. So as you can see here, we have now reached 5% at the after the last meeting in March. Okay. Another thing to look out for would be, right, as we scroll down, there's also other economic data. Something that we would also need to see is GDP numbers, right? So if the US economy is strong, GDP is strong, we can expect the Fed to still continue raising interest rates if they need to do so, right? If the economy is stalling, we have negative growth or negative quarterly growth of GDP, then something is wrong, right, with the economy, and the Fed is very likely to pause or even cut interest rates, right, which would further weaken the dollar, weaken bond yields, and drive the dollar index lower against its major currency pairs. Okay, so if we look at GDP here, so you can see GDP after the COVID lockdowns, GDP rebounded strongly in December 2020. I believe this should be the fourth quarter of 2020 or the third quarter, this result. And then uh, it's been growing pretty steadily. And in the first half of 2022, okay, so this is Q1, Q2, sorry. Okay, although this is saying here June and September, but this is actually the GDP data for Q1 and Q2 of 2020, where we had two periods of shallow negative growth, which constitutes a technical recession, right? And then followed by a strong rebound in the second half of 2022, where growth bounced back to about, what is it here? Let me see. Okay, 3.2% and 2.6%. So we have strong growth uh, to end 2022. All right, okay. Okay, so now we shall close the graph. And if we click on the folder, right, it'll show us that the source for this piece of information is the Bureau of Economic Analysis. If we click on latest release, it'll also take us here. So you can see the latest GDP data was announced on 31st March. And you can find out more details. Oh, wait, sorry, this is by state. It should be this one here, sorry, on the 30th of March. Okay, so you can give us more details and information regarding the state of the economy. So after looking at what central banks do, we look at GDP numbers as well. The next piece of information to look out for would also be ISM manufacturing numbers, right? PMI numbers for services sector and manufacturing sector, right? Because GDP is announced on a quarterly basis, although you do have updates along the way, they are not as regular. The data is not as regular as other agencies. So if you look at ISM PMI manufacturing, right, we click on it. ISM stands for Institute for Supply Management. Click on latest release. It takes us to their website. Okay, so accept cookies. So we have PMI reports, purchasing managers index reports for the manufacturing services sector and hospital. Hospital was something relatively new that came up just after COVID, but we will look at more on manufacturing and services. So if you click on view charts for both manufacturing and services, right? Are you okay? It takes us to shows us the overall state of the economy on a monthly basis. This is for the manufacturing economy, manufacturing sector, where we can see manufacturing has actually been contracting since the third or fourth quarter of last year, and is still in a contraction zone. So any reading below 50 means that this sector is contracting, and any reading above 50 means this sector is expanding, right? And here you have the sub indices as well: new orders, production, employment, inventories, prices. So one of the reasons for, okay, so similarly, this is for services sector. Services are still expanding pretty steadily, although the latest result dropped to 51.2, but it's still in expansion territory. So you can see the US economy is being held up by the services sector, right? And also let's open this up. Okay, so you can see there's similarly for both manufacturing and services sector, there are sub indices such as new orders, employment, prices, imports, exports. So what I'm going to zoom in on here is the prices indices, right? Because the main reason central banks are raising interest rates is due to inflation, right? Rising inflation. And in order to combat inflation, the Fed can only do one thing, and that is to raise interest rates, make lending more expensive for corporates, for retail, for households, right? They have a very blunt tool, and that's the one of them primary tools that they can use to try and combat inflation. Okay, so why is prices important here? The prices sub-index for both manufacturing and services. right? So if you scroll further down, right, so you can see throughout from early 2021, the prices index for the manufacturing sector was already at pretty high levels, right? It was almost, this looks at, yeah, almost 90, right? Almost 80 plus onwards. So the prices indices were already elevated throughout 2021, which should have uh, signaled to the Fed that probably was already time to raise interest rates in uh, 2021 instead of waiting all the way till the start of 2022. So the prices indices for the manufacturing was elevated. Similarly, we should see something similar for the services sector as well. The services sector prices were also increasing pretty rapidly and remained constant throughout uh, 2021, 2022 until the middle of 2022, where it has been descending uh, pretty steadily as interest rates were raised. So similarly, for the manufacturing sector as well, the prices indices were also dropping. So what this means to say that is the rising interest rates by central banks, especially the Fed, made borrowing expensive uh, for corporates, for manufacturers, and all other participants. And when things become more expensive, generally demand pulls off. So as demand pulls off, price will start to recalibrate and probably uh, trend lower. So as demand pulls back, price prices for the in the manufacturing sector and services sector started pulling back. So you could see the effect of um, inflation or the effect of rising interest rates on the prices indices of the services and manufacturing sector. So this is important because this also relates to the overall CPI numbers, right? Inflation data. So as prices fall, CPI falls, the the job of high interest rates or the tool of high interest rates is helped to slow down inflation. So if you look at annualized inflation, right? And speaking of inflation, that is the number that is coming out today, right? 8:30 p.m. UTC plus 8 is where the Fed, sorry, not the Fed, the Bureau of Labor Statistics, BLS, will announce their inflation figures for the month of March, right? So just before we jump into inflation, we can also look at where is it? Non-farm employment change, okay, and the unemployment rate. So another important fundamental factor to look out for the US is the employment reports. So this is the non-farm employment change and unemployment rate. So similarly, if you were to click on latest release, right, it takes you to this page. So basically, Forex Factory is the primary website that you need to remember because all the other sublinks can be found on their website. So it takes you to, so we clicked on employment non-farm change. So it takes us to this page. Okay, it's always easy to visualize data or information through a chart. So if you scroll right to the bottom, you will see a link for news release charts. Okay, so let's just click on that. Okay, so the first chart that it shows us is the civilian unemployment rate. So as you can see, after spiking as high as 14.7% in April of 2020, as economies reopen, uh, jobs, companies started hiring again, the unemployment rate fell pretty sharply and steadily and has been hovering between 3.4 and 3.7% for the past, nearly a year now, right? So despite uh, the tech layoffs that we've been hearing about a lot, unemployment rates are still historically low. And this tells us that the tech sector is just one uh, industry in a wide range of other companies, right? So it may not be uh, the tech layoffs, although they are high in absolute numbers and in relative numbers to the size of the company. It's not representative. It's not representative of the entire American workforce, right? So you can see unemployment rates have been pretty low. So this tells us, together with uh, non-farm payments. Okay, so non-farm would be, yes, here, employment by industry, I believe. So click on employment by industry, click on go. Yep. So this gives us total non-farm figures, right? So if we just take out private, is just a subset of non-farm. So we shall just look at total non-farm. So as you can see, after the huge drop uh, in the workforce, right? The workforce numbers, they have they have surpassed the pre-COVID highs and are making all-time highs here. So basically, what you're seeing for the month of March, there are a total of 155 million Americans currently employed. So by looking at unemployment levels, which is the total non-farm figures, and the unemployment rate, it tells us that the workforce is strong, the labor market is tight, so the Fed can still continue to raise interest rates if they wish to do so, right? Because if unemployment rates are rising drastically, non-farm numbers are dropping, it tells us that more people as a whole are being laid off. And this is a scenario where the Fed may actually start to pause or even start to cut interest rates. So this is another economic data point that is worth monitoring and to understand the rationale behind the Fed's movement, right? Or the Fed's actions rather. Okay. So next, okay. So before we go into the last one, which is CPI. So we've looked, just to quickly cover or to review, we've looked at the FOMC events where the Federal Reserve raised interest rates. It's important to know how much they're raising interest rates. And it's also important to look at their statements and the press conference to see how hawkish or dovish the committee members are. They would also look at GDP numbers to see the actual overall strength of the US economy. And but because GDP numbers are released on a quarterly basis, right? They do not give us timely information, whereas other agencies or information sources such as the manufacturing and services PMI numbers give us a monthly update. And then we can also look at non-farm employment change and unemployment rate, which finally brings us to another important fundamental indicator, which is CPI or inflation. All right, so if we click on CPI in the folder here and click on latest release, again, it takes us to the BLS page where we have tables and text, and the easiest way to visualize whether inflation is rising or falling is by looking at the charts. So we'll scroll down and look at news release charts. Okay, so if you look at the charts here and you click on 12 months percentage change over the past 20 years, click go. You can see the historical performance of inflation on an annualized basis. So we are looking at all items here. And if you look at all items less food and energy, right, although the color scheme is not so great, we have dark red or brown and we have a lighter shade of red here. So you can see both headline inflation and core inflation have been rising. And after headline inflation peaked in June at 9.1%, it's been falling pretty steadily, whereas core inflation, which doesn't include food and energy, has taken a longer time to pull back. So as you can see, the latest readings here are for the month of February, and the next one, the next data point will be March, and that data is being released today at 8:30 p.m. UTC +8. So if headline inflation on an annualized basis drops to lower than 6%, and for core drops to lower than 5.5%, that means naturally inflation is falling, is continuing to fall, and that bodes well for the Fed because it makes their job easier. So it's very likely that moving forward in May, they may not consider hiking interest rates because if inflation is continuing to fall, then for them to keep interest rates at 5% is probably the next best thing to do. So what this means that markets will anticipate that the dollar will weaken and bond yields will fall. Now, why this is happening? Because when markets are expecting the Federal Reserve to be less hawkish, the dollar will fall and uh, the bond yields will also fall. So if you look at this chart here, when inflation peaked in the middle of June 2022, it's about the same time where the dollar index also peaked and bond yields also peaked. So now with that, we shall look at the charts, okay? All right, so this is a DXY chart. Let's just go to a weekly chart so it's easier to visualize what is actually happening. Okay, so as interest rates were being raised aggressively by all central banks, particularly the Federal Reserve, the dollar index was also rising. It went from 95 to all the way to about 115 in within 6 months. And similarly, let's just do a dual chart so it's easy to. Okay, right. Okay, so this is a dual chart here. So what I'll do is for this, I'll switch everything to weekly. The first chart, I'll put the DXY. Okay, and this chart below, I shall put the US 10-year bond yield. Okay, so this is a nominal United States 10-year government bond yields, which is a good indicator of where of what the market expects in terms of interest rates. Okay, so as you can see, at the start of 2022, the Federal Reserve was raising interest rates aggressively due to rising inflation. Bond yields were rising from about 1.5% all the way till the middle of to June to about 3.5%. And similarly, the dollar index also rose from 95 all the way to July, July, hitting about 110. And after a slight pullback, the Federal Reserve was still raising rates, and bond yields and the dollar index made new highs. So this is important because as inflation is rising, the Fed has only one tool or a couple of tools in their toolbox to combat inflation, and that is to raise. One of them is to raise interest rates, and the other is to reduce their balance sheet. These are the two primary tools that they have, or these are the two main ones that's easier to understand for all of us. So in this period, when you have rising bond yields, rising dollar index, naturally, it means all the major currency pairs, your Aussie, your Euro, your Pound, your Kiwi, your CAD, your Swiss franc, and your yen, they're all going to weaken considerably against the dollar. So this is a period where you would be looking to long the US dollar for most periods, right? Of course, there are pullbacks along the way because this is, mind you, this is a weekly chart. Definitely there'll be retracements along the way, but you can see the general trend was strength in the dollar, right? So when you have strength in the dollar like this, you would be looking to go long at any pullback in the dollar, in the strength of the dollar. And as we know, inflation peaked around June, July, and that's when market expectations also reversed, despite the Federal Reserve raising interest rates and keeping them high. Bond yields actually started to pull back and range between 3.4% and about 4%. In that same period, the dollar index has dropped significantly, right? You would think that with the Fed keeping interest rates at this, which was at this time maybe about 4.5%, and raising it to 4.75, and now finally 5, you would think that the dollar would still remain strong. But no, in fact, actually the dollar has sold off very significantly, or very significantly, while bond yields have more or less stayed within 3.5 and 4%. So what this tells us is markets are expecting the Federal Reserve to eventually pause and cut rates. So basically, from this point onwards, in the third quarter or fourth quarter of last year, the dollar, naturally, as the dollar index falls, all the other currency pairs have gained against it. Right. So despite the Federal Reserve keeping interest rates high, the dollar has actually weakened. So if we just quickly look at, okay, so just keep the top one as the dollar index. I will switch the bottom one to Aussie. So similarly, as you can see that with the crosshairs, right? This is a weekly chart. So as the dollar index fell, despite the Federal Reserve raising rates, the Aussie gained, right? Because the Aussies were still, the Australian Central Bank, Reserve Bank of Australia, was still increasing rates. Federal Reserve was still increasing rates, but the dollar was actually selling off. And so it's important to notice these changes in price points. And now you can see that we were in a period of downtrend for the dollar from October all the way till uh, end of January this year, before it pulled back up again, retraced higher, and then finally coming back down again. So similarly, if you were to look at, oh, wait, hang on, let me keep this as DXY, top chart DXY, bottom chart, switch to Euro. So similarly, it tells the same story again. With dollar index falling, the Euro started rising significantly, right? Similarly for pound, same story here. Kiwi, also you see a similar story. And let's just look at the last one, which is the dollar yen, right? Okay, dollar yen is a very interesting example because you have two very divergent central banks. You have the Federal Reserve, which was actively raising interest rates, and not only actively, aggressively raising interest rates from the start of 2022, whereas the BOJ, or Bank of Japan, have been in a perpetually in a negative interest rate environment. So there's a big divergence in monetary policy between the two central banks as of 2022. Fed was increasing rates aggressively, going as high as 5%, whereas the BOJ kept interest rates at negative 0.1%. So you would think that with this monetary policy in place by the respective banks, you would think that dollar yen would continue to shoot higher. But no, actually, in fact, the dollar yen peaked at the same time as dollar index, and it's basically a mirror image of the dollar index, right? So this is because the yield differential between the US and Japan started to fall. So now I'll show you how we can use TradingView to help us chart the yield differential. Okay. So the yield differentials between countries, and we will actually help us determine the general trend in the currency pair, and also potential turning points, and also identify long-term trends. So once you know where the turning points, where the long-term trends, you're able to zoom in on daily charts, four hourly charts or hourly charts, and uh, use your appropriate or your preferred trading strategy and style. Okay, so what we're going to do is, on the top chart, we'll change it to the US 10-year yield. So just type US 10Y, right? So this is the United States 10-year government bond yields. Okay, so that's the top chart. Bottom chart, we're going to change it to Japan. So that's JP, I believe 10Y. Yes, okay, so JP 10Y. So that's the Japan 10-year government bond yields. Okay, so right now, you can see with respect to bond yields, The dollar for the US dollar from the start of 2022, it was about 1.6, 1.7, was rising steadily throughout the year, peaking at about 1.43%. So this is for the US 10-year. And similarly, for the Japanese yield, 10-year yield, it was relatively stable at about 0.2 to about 0.25%, right? And it was only here in December when Japanese bond yields really shot up. Okay, this was due to some central bank intervention. I forgot what it was by BOJ. Yes, okay, I remember now because the dollar yen had moved far too high, and because of certain requirements by the Bank of Japan, they had to strengthen the value of the yen. So when they strengthened the value of the yen, there was a big intervention by the Bank of Japan, and this intervention caused Japanese bond yields to spike. So when we had this spike in Japanese bond yields, that's when the yen also strengthened pretty considerably. Okay, so now what I will do is for the bottom chart, I will take the US 10-year bond yield minus the Japanese 10-year bond yield. So the good thing about TradingView is not only can you view the individual charts for bonds, for currencies, especially for bonds, you're able to do the yield differential as well. So just as simple as typing US 10Y minus JP 10Y will give us the yield differential between the United States and Japanese government bonds. So this bottom chart here is showing us the yield differential. And just to put things, and what we'll do, we'll change the top chart. Sorry, we'll change the top chart to dollar yen. Right. So as you can see, they are actually practically a mirror image of each other. So in a sense that if you wanted to know the direction of any currency pair, it would be good to look at the yield differential as well for that particular pair. So for dollar yen, you look at, of course, the US and Japanese 10-year bond yields. For Euro USD, you would do it similarly for European yields, or maybe the German and French 10-year yields versus the US 10. Aussie, same thing, you do Australian 10-year bond yields minus US 10-year bond yields. So by actually tracking the yield differentials together with inflation, right? You see where inflation is heading. Okay, you can see inflation has peaked. Right now I'm on the chart, on the BLS chart, where inflation has peaked and dropping. So as inflation is falling, this sets into gear, sets into motion that markets are expecting the Federal Reserve to be less hawkish. Although the Fed will still raise rates, but the hawkishness or the less hawkishness is actually displayed in the movement of bond yields. So that's why it is important to track bond yields, bond yield differentials together with inflation data, employment data, ISM reports as well as GDP, right? So once you have this few fundamental data points, right, it actually helps you paint the overarching picture of what currencies are doing, what bond yields are doing, and what central banks are doing. And basically, it gives us a relatively good idea of the state of the economy for each respective country. So as you can see, okay, so bottom chart here is the yield differential. So from the start of 2022, the yield differential between the United States and Japan was rising aggressively. Of course, there'll be pullbacks along the way, consolidation, range-bound period as well between here, May and August as well, right? But the dollar yen continued pushing all the way till 150, right? Look at it broke 150. Now, because of this movement in price, the BOJ had to intervene. There was a big intervention action by them, which led to Japanese bond yields to spike, despite interest rates being kept at negative 0.1%. So the BOJ didn't alter their interest rates, but they actually intervened in the open market, right? By buying Japanese yen. And when they bought Japanese yen, the yields of Japanese bonds increased. So as this happened, as Japanese bonds yield on the Japanese bond increases and the yield on the dollar stays steady or starts to drop, you will see the yield differential start to fall. So if you are observing the yield differential and paying attention to what the BOJ did with regards to their intervention policy and looking at this DXY and subsequently putting everything together, you will get a complete picture or an overarching picture of why the dollar weakened, why the US 10-year yield dropped, why the Japanese 10-year yield increased, and then subsequently you will see the fall. You would understand the fall in the yield differential. You would understand the sharp pullback in dollar yen as well. So during this period, didn't matter whether Federal Reserve kept raising interest rates or whether Fed's interest rates were at 4.755% and Japanese interest rates were at negative 0.1%. If you just look at interest rates differential, it's still in favor of the United States, but that's not reflected in the price of, or not the price, but that's not reflected in the yield on the bonds. It is not reflected in the strength of the dollar, and it's not reflected in the currency pair itself. So that is why it is important to look at about 4 or 5 fundamental indicators, and this will actually help you to paint uh, the larger picture, right? Because we are looking at weekly charts here. It helps you to paint the larger picture, help you determine turning points in currencies by looking at central banks' action, looking at bond yield differentials, looking at inflation, and plus other information, right? You don't need to look at everything because there's simply too much, right? It's as a individual trader or retail trader, right? There's so much info out there. So what do you look at, right? What do you focus on? So I would say look at what the big central banks are doing. Look at where their interest rates are. Look at where inflation is. Look at where GDP and unemployment figures are, right? This all this data comes out on a monthly basis. So it's not like something. It's not that something we need to track regularly, but then pay attention to the bond yield differentials, right? Because they will signal potential turning points in the currency pair. So that is why I like to use the dollar yen in this example for to illustrate the importance of bond yield differentials, the importance of intervention by central banks, despite the respective interest rates still being very divergent, and to understand why certain moves in FX occurs, right? So once bond yields, the bond yield differential peaked and started heading lower in favor of the Japanese yen, the dollar yen also fell significantly, right? And then it fell, yeah, from 150 to as low as 127. And then as the differential picked up again in favor of the United States, this was another turning point here, right, on the weekly chart. It didn't go lower. It actually formed a base here, and the yield differential started driving higher. So this would have been a clue to indicate that, okay, there's a potential change in direction, and we could expect the dollar yen to uh, retrace some of the losses that it has made. And likewise, again, as inflation expectations also continue to drop, with inflation uh, continuing to print lower, headline inflation and core inflation continuing to print lower, bond yields in US also started falling, and likewise this is reflected in the yield differential, and hence the dollar yen fell, right? Okay, so I think these are some of what I've covered is basically where to look for fundamental data, which are the key US fundamental data to look out for. And similarly, you could do that for other currency pairs. but that might be, frankly, that's probably a bit too much work, right? Just looking at the US alone is takes up quite a fair bit of time for an individual person. So just maybe perhaps I would say concentrate on the US, right? Macro data. So look at GDP, look at GDP numbers, look at ISM numbers, and especially look at prices because they will tell us where prices for the services and manufacturing sectors are heading. And this relates back to overall inflation. Look at employment numbers, right? Look at how strong the labor market is in terms of total non-farm and in terms of how low the unemployment rate is. And also look at inflation, whether inflation is trending lower. Is it staying constant, consolidating, or is it starting to pick up again? And ultimately look at bond yields, right? The bond yield differential, right? So, are there any questions, or would you like me to revisit any particular topic or any uh, particular part of this webinar? Right. Okay. Otherwise, I can move on to something else, right? Something else that's coming up big today. So we have, as we've mentioned, we have the. Okay, let's just zoom in to. Yes. So of course. So today, 12th of April, 8:30 p.m. UTC +8, we have U.S. inflation data being released. So this is going to drive a lot of the moves in FX and equities and gold later this evening. Well, in Singapore time or in Asia time would be evening, right? So in about 1 hour 40 minutes, right? Doesn't matter where you are. In 1 hour 40 minutes is where we will see a lot of big moves in currencies, currency pairs, in gold, and also in um, equities, right? So just as a quick, okay, so since we're talking about gold and inflation, okay, let me switch this to DXY. Okay, again, we're looking at weekly charts. So the top chart is showing us DXY, the dollar index. Bottom chart is showing us now gold. Okay, so let me get rid of volume. Okay, right. So since we are talking about inflation, I think, and we have a big data point coming out this evening, right, or in a very short time. I think it's good to cover this as well. So what we're looking at now is the weekly chart. On the top, you have the dollar index. Bottom, you have gold. Okay, so similarly as 2022 began, uh, central banks started, the Federal Reserve started raising rates aggressively. Dollar index shot up, bond yields increased, and also uh, the geopolitical event occurred. Like, right, we had the invasion of Ukraine by Russia, so that created a big demand for gold as as a safe haven asset. So that drove up the price of gold in the first quarter of 2022. But what happens during this period also is it is important to note why. It's also something to take note. Why did um, gold fall after a major geopolitical event? You would think that investors, central banks would continue to buy gold and drive it higher. But actually, because we know that the strength of the dollar is inversely correlated to gold. So as the dollar increased, right, despite there being a major political event, geopolitical event, the strength of the dollar actually caused is not the only reason, but it's one of the reason that caused this the price of gold to pull back very significantly. So this is also to do with combination of dollar strength and combination of what we call real yields. Okay, real yields are 10-year bond yields adjusted for inflation. Okay, so what that hap- what that what has happened is in this period when the gold peaked 2050, 2060, went down as low as 1600. During this period, real yields were actually rising. So when real yields rise, uh, together with the strength of the dollar, this negatively impacts the price of gold. But then the dollar index peaked in October, right? At the same time, gold bottomed, and as the dollar pulled back significantly, and as interest rates, as inflation started to pull back as well, real yields turned more negative, right? I don't have a chart for real yields here, but just try and visualize it. So as real yields became more negative, together with falling dollar, falling inflation, gold became a more attractive hedge against inflation. So what I'm trying to say is basically in this period, as dollar index strengthened, bond yields strengthened, gold is generally not a good hedge against inflation. Hence, that's why we saw the sell-off in gold. But after that, the macro picture changed, whereby the dollar index started falling aggressively. Inflation also started falling a little bit. Bond yields started falling, and in this environment, bond becomes a better hedge. Gold becomes a better hedge against inflation. Hence, we see the bid up in gold here from about 16,000, 1600 all the way to almost breaching 2000 here in January, and before pulling back again because as the dollar rose, it pulled negatively impacted the price of gold. And also we had the banking scare here, right, in March. So in early March, we had the fallout from Silicon Valley Bank, Signature Bank in the US. Plus, we also had major issues in Switzerland, coming out of Switzerland as well, with UBS eventually having to take over Credit Suisse. So we've also had a banking crisis here, which sparked a drive uh, for gold as a safe haven asset. So as we see dollar index continue to fall, bond yields continue to fall, we may see gold stay elevated around this level. So which brings us to this um, uh, CPI event coming up. So if CPI, so there's several factors to look at CPI. You've got headline CPI, which contains all the components, and you've got core CPI, which doesn't include food and energy. So they'll be looking at uh, the monthly growth of headline and core CPI. They'll also be looking at annualized growth or the year-over-year growth of headline and core CPI. So if these data points, there are four major data points to look at. So if as a whole they all uh, print softer than their estimates, that means they come in lower than all their estimates on a monthly basis, on an annualized basis, and also compared to the previous month, it is very likely that bond yields will drop, the dollar index will drop, and this would potentially create another tailwind for gold. Conversely, if inflation comes in hotter than expected across all uh, four metrics, then it's very likely that bond yields will rise. Dollar index may rise as well, but if bond yields rise aggressively, this would potentially cap any further gains on gold and may drive it lower, right? Okay, so not only have we covered fundamental strategies for forex, we've also looked at a bit of gold because it all interrelates with each other, right? You look at forex, currency pairs, you look at bond yields, you look at inflation, you look at dollar index, the strength of the dollar, the weakness of the dollar. You look at bond yield differentials, use the 10-year bond yields and the differentials between the countries to see where um, price is headed, where the major turning points, where the major inflection points, and look out for central bank announcements, what they are doing. And yeah, this would help you picture piece everything together to form a large picture. And then once you have it, once you know what the overarching uh, theme is or the environment is, you are able to scale down into daily charts, 4 hourly charts, and hourly charts. So what I've presented here is mostly through weekly charts. So at least we are able to understand the trends, the longer term trends, and also potential turning points, right? Okay, so um, I've come to the end of today's webinar. I hope this has been a uh, good session for everyone. And if there are any questions, feel free feel free to fire away in the chat. And yeah, I'll stick around for I guess a minute or two. And if you have any questions, please, yeah, please let me know whether it's something about CPI today or if it's something about what we've discussed recently. I mean, discuss in this session, or would you like to clarify any other points or any other topics? Wait, sorry. Ah, sorry. Okay, the Harvard. Okay, there's a question I missed. Completely missed this. Okay, sorry. Okay. On the day of this release of manufacturing PMI data, does the dollar move the same way? No. Okay, wait. I'll type the answer. Okay. So basically, I'll type the answer to Howard and also explain it live as well. Okay. His question is on the day of the release of manufacturing PMI, does the dollar move the same way the NFP data moves the data? Okay. So generally speaking, PMI numbers are important, but they don't have that much of a significant move in uh, currency market. I mean, it will drive sort of the longer term movement, but on the day of release, it's not as impactful as NFP. NFP data releases tend to have more, or not tend, they create more volatile instances rather than PMI releases, right? So I think that's yeah, different. That's something to understand as well. So different news events have greater significance and introduce higher volatility than others. Okay, so also just type the answer as okay. I'll just answer it. I've already answered it. Yep. Okay, then right. Okay then. All right. Okay. Yeah. Okay. So I've come to the end of the webinar. So yes. So I hope you guys have found this useful. And remember, it's about trying to understand the big picture, so that we can scale down and zoom down into your particular your favorite time frame, and then you are able to identify trading opportunities, be it on the short or long side, and then try to successfully create high probability trade trades and trade outcomes for yourself. All right. Okay. Thank you, everyone, and yeah, have a good trading week. All right. Take care, guys and ladies and gents. All right. Bye.